we are going to start talking about chapter 3. This particular part of the book has got 2 chapters. It's broken into part 1 and part 2. So we're going to be studying this idea of business income and expenses for 2 units. And we're really going to dig into the individual items. So you can see, just to take a quick scan of our learning objectives, we're going to go to a Schedule C, and if you remember that, that's to report self-employment income. As a piece of that, number 2, we're going to look at inventories and cost of goods sold. We're going to look at all sorts of different deductions on that third bullet mark, from transport, travel, meals and entertainment, etc. More deductions in the 4th bullet point. And lastly, we're going to take a look at things like how do you get to write off a portion of your home office? What do you do if you have hobby losses? What do you do if you have bad debts? Defining a trade or a business. So this is one of the most interesting things as a tax practitioner is I'll have people come regularly and they'll do something that they enjoy doing, like interior decorating or taking photographs or quilting. And occasionally they'll sell a quilt or they'll sell a photograph or they'll, commission with a client to do some interior design. And what happens then is that they think they're in a business and they want to write off all the expenses to do with it. Well, down here on the 2nd bullet, for a deduction to be considered deductible for a trade or business, it must qualify in all 3 of these ways. It must be ordinary and necessary. It must have a legitimate business purpose. And this is different from a hobby. In those examples I just gave you, the quilter and the interior designer and the photographer, they're not really engaged in a business. They're engaged in a hobby. And lastly, that whatever the expenses you're trying to write off, it's got to be reasonable. And this has a really wide, some wide parameters. For example, in Missoula, if I'm taking out a client for a dinner, I should very easily, it would be reasonable to expect that a dinner for 2 would be under $120 with wine and a tip. Okay, if you're doing the same thing in Manhattan, it would be reasonable to expect to spend $500. So, the IRS tells us that based upon whatever it is I'm expending money on, that the fees that I'm generating from it need to be reasonable as compared to the cost. So the $500 dinner in Manhattan isn't going to fly if I'm getting, $150 worth of fees out of it. But more than likely, I'm going to be generating $5,000 or $10,000 worth of fees. So Schedule C, as you remember from the first week when we memorized our schedules, is for a trade or business. A CEZ is if you actually have a short form. And you can use the short form, the CEZ, if you meet a number of criteria. And if you want to see those criteria, it's on page 3-3. I actually don't know them off the top of my head. So I'm going to go take a peek. I think it has to do with inventory, depreciation, home office, things like that. Yeah, so you can't have any inventory, you can't have a home office, you can only use cash basis, your expenses are $5,000 or less, so it's a small business, you're a sole proprietor, you don't have a loss. So a CEZ is up for a very small, simple business. The 2nd bullet tells us that on pages 3-4 through 3-6 is our actual Schedule C. And you will, the parts of the Schedule C, and you'll be working pretty tightly in this, with this. Gambling winnings. Actually, I have a really good friend. She's from Thailand, and culturally, it's something they seem to like to spend a lot of time doing. And she won $30,000 a couple years ago at Quatucknuck. Last week she won $2,200 at the somewhere up at the Gray Wolf or the Gray Wolf. Um, so she's not a professional gambler, so she doesn't put her winnings on a Schedule C, but she does have to report them. She reports them as other income on line 1040. I'm wondering if I just jumped ahead all the way to the end. Okay, sorry. Let's go back here. For some reason, that took me all the way to the very end. So we're on this screen. Oh, no. Okay. So on the 1040, she does have to report that as other income. If she has losses in excess of her winnings, she can only claim the losses up to the amount of the winnings. But it doesn't go on the Schedule C unless she's a professional gambler. Self-employment tax. Self-employment tax is filed on a form Schedule E that comes with the 1040. When you fill out a Schedule C, it will generate a Schedule SE, which is where your self-employment tax goes. And we know there's two components to it, right? Social Security, which we called OASDI and payroll, and Medicare, which we call HI and payroll. And we know that the 6.4 or the 12.4 is because as a self-employed person you pay both shares of SC. And down here, same thing, employee plus employer. The cap for the year that we're preparing is 118.5 for Social Security. And also be aware that when you calculate the self-employment tax, that there is a deduction for AGI equal to half of the self-employment tax. So maybe we should take a peek at a 1040. I think we were working on page D11. The self-employment tax itself goes on the back of the tax return, and that goes on line 57. The self-employment tax goes on line 57. And then the deduction for half of the SE tax goes on the front as a deduction 4, and that is line 27 on the front. Also, don't forget, this is part of the ACA, the Affordable Care Act, or Obamacare as it's widely known, that there's a 0.9% additional Medicare surtax if you're high income, and that's defined as $200,000 if you're single, $250,000 if you're married filing joint. Okay, inventories. Inventories are a significant deduction for many retail organizations. And if we go back to the page 3 dash, where are we, 5, you can see again that there's different parts of the Schedule C. Part 1 on the bottom of page 3-4 is the income section. And you can see line 4, they want to know cost of goods sold from line 42. Cost of goods sold section is over in figure 3-5, and it is on the back of the Schedule C. And this is where your inventory methodology comes into play. So you can see on line 33, now I'm looking at the cost of goods sold part 3, figure 3.5 on page 3.5, and it tells us in line 33 that we need to tell the IRS if we use cost, lower of cost or market, or something else, and was there any change in how we determined our cost basis. In other words, did we go from FIFO to LIFO or LIFO to weighted average? So basically, just as a refresher, LIFO is last in, first out, meaning that our cost of goods sold is the newer, more currently purchased products, so probably higher number with inflation. And FIFO, and again, these are cost assumptions. It's not really how your inventory physically flows. First in, first out means that your oldest product was sold first, and therefore your cost of goods sold is probably a lower number in an inflationary period. Almost all businesses choose LIFO as their costing method, and the reason is, of course, as I just said, LIFO gives you, in a period of inflation, a higher cost of goods sold. So if you've got a higher expense, that leads to a lower taxable income. With that in mind, if you use LIFO for tax purposes, it's also required that you publish your GAAP statements using LIFO. Transportation. So the next thing I want to talk about, there's two categories of business expenses, transportation and travel, and this is talking about transportation. And the difference between transportation and travel is right here in the green. The taxpayer doesn't have to be away from his or her tax home to get a transportation deduction. So for example, my son lives in San Francisco. He goes out to different job sites. Every time you cross the Bay Bridge or the Golden Gate Bridge, you pay a $1 toll. That's a transportation expense to him. It's a cost of being employed with his company and getting to the job sites. So, does he get to write off his tolls? Sure. Does he get to write off the cost of leaving his home in the across the Bay Bridge and driving into San Francisco proper? Never, because that's commuting. Commuting is never deductible, except if you're being asked to leave your metro area and travel to a place that is not your regular place of business. So for example, if they had him go up to Sonoma or down to Silicon Valley to bid on a job or to meet an architect, that would be outside of his regular job tasks and his regular place of business. Then he would be able to write off the cost of transporting himself there. Additionally, if you are traveling between home and a temporary workplace, when you have a regular place of business, you get to write that off. When I lived in Australia and taught there for 6 months, I had a regular place of business. That's here. So every day that I traveled between my house in Wagga Wagga, New South Wales, and my temporary work, which was Charles Sturt University, every single day I got to log and write off the cost of transportation because I was traveling between home and a temporary workplace. And now I'm just giving examples here. And then lastly, this is self-explanatory. When you have an office in your home and you don't have a regular place of business, so say I'm an insurance salesperson and I work out of my home, every time I go to meet a client, every time I go to assess a claim, I can write off my transportation because every time I leave home, I'm leaving my principal place of business. There are no commuting expenses. Additionally, I can always get any costs associated with hauling my tools, my instruments, if I have a mobile kitchen or anything that I move with me, the cost of that flatbed or that trailer or the tires for that, the allocable gas to that is always a write-off because those are the instruments of my occupation. So does it just have to be car? No, it can be anything. If I live in Palo Alto and I need to fly to Sacramento for a day, the cost of my plane ticket is deductible if that's in the course of business. Many parts of the East Coast you use rail, so if I need to go from Philly to Boston and I use rail, that's deductible. Bus, and then when you get to auto, which was what I was giving in all the examples in the prior screen, we need to have this conversation about whether we're using actual amounts or standard amounts. So this first bullet here basically just tells us that really any of a wide array of transportation modalities are deductible. The reality is here in Montana, probably 99% of it is auto. So that's the first thing a client will want to know. I drive my car for work, I drive my van for work, I drive my truck for work. How much can I write off? The first thing that I want to assess is what's going to be more beneficial for them. Is it going to be better for them to use a standard mileage deduction, which in 2015 is 57.5 cents a mile, plus some other things that I'll talk about in a moment? Or is it more beneficial for them to tally up all their actual costs? I will tell you that in probably 85 to 90% of the cases, it is more lucrative for them to take the 57.5 cents a mile. That is a very generous allotment for a per mile cost to run a vehicle. If you choose to do, but I do the calculations. I get them to estimate their actual costs, and I always do a little worksheet and do a comparison to make sure that I'm doing what's most beneficial. But on the whole, I would say almost everybody takes the mileage, the standard mileage. You get 57.5 cents a mile plus the business portion. In other words, if I drive my car 30,000 miles in a year and 10,000 of them are for business, then 1/3 or 33% of these items are attributable to the business portion. You can only take off the interest, you can only deduct the interest on an auto loan if you're self-employed. So for example, if I'm a professor at the University of Montana and I regularly drive my car back and forth to Billings because I'm starting a satellite program there. I can't write off 1/3 of my auto loan interest because I'm not self-employed. I'm an employee of the university. If, however, I was a commodity saleswoman and I traveled all over the state in my own car, I could certainly, in this scenario, write off 33% of my auto loan interest. Okay, not all your payments, just the portion that's attributable to your interest. In order to be eligible to use standard mileage deduction, you have to meet these 4 caveats, and you can read through those. You probably don't know what the 3rd and 4th bullets are. Basically, pretty much anybody that wants to use standard mileage deductions that I've come across, comply with these 4 caveats. So that's not usually a deal killer. Or conversely, and like I said, I do a worksheet for all my clients, you can choose to take actual expenses. And if you choose actual out of the gate, so then you can't shift to standard. So for example, I just got a new client and she's a leader, and she does beautiful fabrics, clothing, she travels around to a number of trade shows and art shows throughout the Northwest, and she just bought a new SUV, mid-sized SUV. And so we ran the numbers, and because of the low gas mileage and the extensive wear and tear, it actually was more beneficial for her. She was one of those rare situations to take actual expenses rather than take the 57.5 cents a mile. And I made her very aware of this. We're taking actual expenses now, and they're going to be more lucrative and more beneficial. But down the road, they're not. Down the road, standard is going to be more lucrative, but we can't change once we've made the decision to start with actual. Conversely, if you do choose standard, you can change to actual down the road. So that's yet sort of although it almost never pencils out that you'd want to do so, you've got that option. Okay, and then lastly here, you've got to keep your actual records In other words, this business use percentage, you've got to keep really good records on what I did on the prior screen, which is, you know, how many miles did I drive this year? And I will have clients, basically nobody, no matter how much I beg them, will do the daily log. So I get them to do a beginning of year and an end of year odometer reading so I can see how many miles was put on the vehicle in total for the year. And then honestly, for most clients, it's sort of a workaround with a lot of estimation. Now I'm a carpenter, I'm a painter, and I worked, 4 weeks out of the year at a gig in Victor. I took 3 weeks of vacation, and the other 45 weeks, I went from my home office in the Rattlesnake to paint around Missoula. So then I just get out my calculator and back in to the number of miles that I think reflect everything the client just told me. And I document that, so if anybody ever comes back and goes, "Where did you get 8,392 miles?" I can say, well, I estimated round trip to Victor for 2 weeks, etc. Okay, so this is really important because this is going to give you whatever the percentage is that you can multiply by those actual expenses. So if I have, auto loan interest, and I have, oil changes in it, my tires, and I have to, get, obviously get it tuned up, and got to put gas in it, I don't get to take all of those expenses. I only get to take the percentage that's my business use percentage. And basically this is what I just said. These are the kinds of items that you can take actual. I didn't actually address depreciation. That's going to be our last chapter. We're going to spend all of chapter 7 on depreciation. It's a little bit of a complex topic, so I'm not going to say a whole bunch more about it now, other than there's lots of special rules about vehicles and depreciating vehicles, because it was traditionally really exploited. The first CPA firm I went to practice with was primarily oral surgeons and periodontists and really high net worth dental people in California. And, this was back in the 80s, and they're driving $100,000 cars and writing them off. Okay, you can't do that anymore. There's luxury auto limits, and your depreciation is really pretty tightly controlled on your vehicles. Personal property taxes, this is just basically the portion of your license plates. And if you've ever looked at your registration and say, if you pay $180 to register your car, there's all these little codes of what the composite of it is. And usually the tax is around, 40% of the total price. Okay, and then we've already looked at this, interest on your car, but only if you're self-employed. If you park and pay tolls, you don't have to multiply by the business use percentage. So back to the example of my son, he pays $8 for a toll, maybe, 100 times or 200 times a year. So say he's got $1,600 in tolls, and he uses his car 43% for business. I don't have to multiply that 1,600 times 43% because every one of those tolls was purely business related, so they don't need to be allocated. That's what makes them a little different, because you don't have to allocate them. Okay, if you're self-employed, where do all of these expenses go? On your Schedule C. Right, if you're self-employed, where does all this go? Schedule C. If you're an employee, right, and that's the example I'm giving you. My son, he's an engineer for a construction firm, so he's not self-employed. These tolls end up on his Schedule A through a Form 2106. Sarah, leave your computer open. Thanks. They end up on a 2106, which carries to a Schedule A. Okay, travel, and this will be the last topic that I'll do for today. Travel is different from transportation because you're leaving your tax home. You're leaving your regular place of business. So in order to deduct travel, you you must obviously be going for a documented business reason. It's got to be ordinary and lavish, and ordinary and necessary, and not lavish. So it is not ordinary and necessary for me to hire my own private jet to go to a meeting in Dallas. It's reasonable that I would be expected to ride, business class or coach on a commercial airline, and I get to take everything that corresponds with that trip. I get to take my actual expenses of getting there, and my lodging. How do I get around the city while I'm there? Do I have to have my laundry done while I'm there? Any tips that I give, a meal. These are tough sometimes to document if you've ever been to a big city and you hand out $5-10 to everybody that opens the door at the hotel and hails the cab and tip the cabbie and tip the Uber guy and et cetera, et cetera. Tips can get to be quite a lot, so I always just carry a little notebook and jot those down. Meals are only 50% deductible, and entertainment is only 50% deductible. Okay, so again, as I said, you need to be away from your tax home to be on travel status. And it doesn't really require that you're away from home overnight, as in physically between 10 at night and 8 in the morning, but rather that you're away from home long enough to need rest. So say that I've got to travel down to Salmon, Idaho, and I drive for 4 hours to get there. I engage in a workshop for 4 or 5 hours, and then I have a meal, and then I've got to come home. Okay, I'm actually not away from home overnight, but the cost of that travel and my meals while I'm gone is going to be deductible as a travel expense. Okay, this one's pretty interesting. Expenses of temporary assignments are deductible, even if it's not practical to return home each night. So this is the example of the pharmacist. I had a lot of that. She worked up in Browning during the week, but maintained her principal residence here. She had a kiddo in high school here. So her family residence was here in Missoula, but she was going up and working in Browning during the week. The cost of living up there during the week, because it was not practical, obviously, to return home each night, was fully deductible for her. When I lived in Australia, I got to write off all my housing, all my utilities, everything, because it wasn't practical for me to return home every night. I was only teaching over there for 6 months, but if I had been there over 1 year, then I would have had to reclassify. I would have had a new tax home, and I wouldn't have been able to write off my housing expenses while we were there. Okay, so what about business trips? Let's make the differentiation between a business trip within the United States and a business trip outside of the United States. Okay, first I'm going to read up here in the green. The deductibility is dependent on A, where the travel occurred, and B, whether the trip is purely business, purely pleasure, or some combination. Obviously, if a trip is purely pleasure, there's no tax deduction for it. So that's why when clients will say, we really want to, as a family, travel to, the desert this winter. Well, are there some clients or some vendors or some, customers that you can talk to down there? Because then you may be able to deduct a portion of your trip as business. Okay, so if trip is in the United States, right here, your travel costs to and from Tucson, let's say, are deductible. But while you're there, everything has to be split between business and personal. So if you spend 4 days traveling around the desert and bird watching and doing all sorts, mountain biking in the desert, and then 3 days in conference, only 3 days of lodging, 3 days of meals and entertainment, etc., are deductible, and the rest are personal. If I'm going to the desert, but this time in Morocco, and I'm spending 4 days in pleasure, and touring, and 3 days at a conference. When you go to Morocco, I've got to actually split the cost of my plane ticket. Up here, I didn't have to split the cost of my plane ticket, only the lodging, the meals and expenses, the taxis, the laundry, all that once I'm there. If I'm going outside of the United States, the ticket itself needs to be split based on the number of days. So my ticket would have been 3 sevens and 4 sevens in the example I just gave you. And of course, all other costs have to be split between business and personal. If a trip is primarily pleasure, say I'm taking my family to Disneyland for 6 days, and then on the 7th day, I'm going to touch base with one of my clients. I don't get to deduct the cost of the plane ticket at all. I do get to deduct 1 day of meals, lodging, transportation, etc. Okay? So essentially, the only thing I get if it's primarily for pleasure is that little bit. Okay, so let's finish up with this one. I'm going to have you work this and then go ahead and look at the solution. And then we will pick back up with this when I see you next Tuesday, which is the 20th of September. And have a great weekend. Okay.